What you're looking at on your screen right now is not a price. It is a placeholder. The number hovering around $70 in the Western silver feeds no longer performs the function that a price is supposed to perform in an economic system. A real price coordinates behavior. It balances supply and demand. It clears markets. What you're seeing today does none of those things. It is an administrative artifact left over from a paper market that has lost control over the physical reality it was designed to represent. The reason this matters is not ideological, and it is not conspiratorial. It is mechanical. The silver market has entered a state of bifurcation where two parallel pricing systems exist at the same time, and only one of them has access to metal. In the paper system, silver is abundant, liquid, and cheap. In the physical system, silver is scarce, rationed, and increasingly unavailable at any price that resembles the paper quote. This divergence is not a temporary premium spike. It is the signature of structural failure. When physical silver trades at levels 80% above the paper benchmark in a developed economy like Japan, the problem is not taxes, logistics, or retail markup. The problem is that the arbitrage mechanism that is supposed to collapse those spreads has stopped functioning. In a healthy commodity market, a gap of that magnitude would be erased almost instantly by institutional actors exploiting the price difference. The fact that it persists tells you that the institutions cannot move metal freely anymore. They are trapped inside the paper layer. To understand why, you have to stop thinking about silver as a trade and start thinking about it as a flow system. For decades, the global silver market functioned because physical flows compensated for financial excess. Western futures markets could expand paper supply far beyond physical availability because excess metal could be pulled from the east when needed. China refined, recycled, and exported silver into the global system, acting as a pressure valve. That valve is now closed. The export licensing regime implemented by Beijing is not a symbolic gesture. It is a structural constraint that prioritizes domestic industrial demand over global price stability. China does not produce a surplus of silver. It runs a deficit. Its solar, electronics, and defense sectors consume far more silver than its mines produce. In the past, that deficit was masked by imports and by a willingness to export refined metal when prices incentivized it. That willingness no longer exists. When a deficit producer stops exporting, the global market does not tighten gradually, it snaps. This is why the registered inventories in Western vaults matter so much. Those inventories are not reserves in the traditional sense. They are the final buffer between paper obligations and physical default. When those buffers fall to a few weeks of global consumption, the market is no longer pricing silver, it is rationing access to it. This is where most analysis fails because it confuses solvency with availability. Banks can absorb mark-to-market losses. They cannot conjure metal that does not exist in deliverable form. A bullion bank can survive a $6 or even $10 billion paper loss if it has capital and central bank access. What it cannot survive is a client demanding delivery when there is no metal to source at the benchmark price. That is the weak point in the system, and that is why the behavior of institutions has shifted from suppressing price to securing inventory. The aggressive withdrawals from registered categories, the straight-line movement of metal from one vault to another, and the refusal of dealers to accept back orders are not signs of panic. They are signs of reprioritization. Participants with scale are no longer trying to manage price. They are trying to manage continuity. This is the transition from a speculative market to a survival market. In such a transition, price signals invert. A low price no longer stimulates demand reduction. It stimulates hoarding. When silver is artificially cheap relative to its physical scarcity, it becomes the most attractive asset to remove from the system. This is Gresham's law operating in reverse form. Bad pricing drives out good inventory. Every attempt to cap the paper price accelerates the physical drain because it subsidizes withdrawal. This is why the paper chart looks weak while vault's empty. The chart is not lying because of manipulation in the abstract. It is lying because it is no longer connected to the clearing process. Clearing is happening elsewhere, through delivery queues, export restrictions, and allocation cuts. Retail buyers experience this first, not because they are important, but because they are downstream. When wholesale supply is pulled forward by institutions, retail shelves empty as a consequence. Premiums explode not to exploit buyers, but to protect dealers from selling inventory they cannot replace. A dealer who sells metal today must be confident they can source metal tomorrow. When that confidence disappears, price becomes secondary to availability. This is why back orders are being refused outright. Accepting future orders in a structurally short market is an existential risk. The deeper implication is that the silver market is no longer governed by marginal buyers and sellers. It is governed by stockpiles and policy. The moment a strategic consumer decides that metal is more valuable in reserve than in trade, the market ceases to be elastic. China's decision effectively removed one of the largest flexible suppliers from the global pool. That forces the remaining system to reprice until demand destruction occurs elsewhere. Demand destruction does not happen at $70. It does not happen at $80. It requires prices that force substitution, recycling, and rationing. Until those prices appear, inventory will continue to be consumed. This is why the banks are not collapsing, but they are retreating. They are unwinding short exposure, not because they fear bankruptcy tomorrow, but because the cost of maintaining suppression has exceeded the benefit. Suppression requires collateral. It requires confidence that physical supply can be mobilized if needed. That confidence is gone. The system is now operating on inertia, not control. And inertia runs out. The first phase of this process is confusion. Analysts argue about premiums, taxes, and temporary dislocations. The second phase is denial. Participants insist that inventories are sufficient, that eligible metal will come to market, that arbitrage will return. The third phase is acceptance, when the price must move to a level that reconciles the paper claims with physical reality. That is the phase the market is approaching. It will not arrive cleanly. It will arrive through volatility, margin changes, forced liquidations, and rule adjustments designed to slow the transition. But the direction is no longer in question. Once a commodity becomes scarce in physical terms and strategically important in industrial terms, the financial layer must adapt or be bypassed. Silver is crossing that threshold. The price you see is no longer a signal of value. It is a lagging indicator of a system losing relevance. The real signal is inventory, flow, and policy. And all three are pointing in the same direction. Once a market enters this phase, the question is no longer whether price will adjust, but how violently the system will resist that adjustment before it yields. Resistance is not ideological, it is structural. The silver market is embedded inside a financial architecture that depends on stability, predictability, and confidence in benchmarks. A disorderly repricing of silver is not just a commodity event. It is a signal failure that propagates across balance sheets, collateral frameworks, and derivative books. This is why the institutions at the center of the system will attempt to manage the transition rather than allow it to clear naturally. Managed transitions are never smooth. They are characterized by volatility spikes, policy interventions, and asymmetric rule enforcement. The tools are familiar. Margin requirements are raised to force leveraged participants out. Trading hours are adjusted. Volatility controls are triggered. None of these tools solve the underlying problem. They only slow the rate at which the problem becomes visible. The core constraint remains unchanged. Physical silver availability is declining faster than the system can replace it at the current price. That creates a feedback loop. Each suppression attempt drains inventory further, making the next suppression more expensive. This is the dynamic that defines the end of a long-running price control regime. It does not end with a single event. It ends with exhaustion. The banks understand this. That is why their behavior has shifted from aggressive shorting to selective covering and inventory acquisition. They are no longer trying to win. They are trying to exit with minimal damage. This distinction matters because it changes the expected price path. Markets rarely move in straight lines when incumbents still have tools. The path forward is a stair-step repricing, not an explosion. Sharp rallies will be followed by engineered collapses designed to flush weak hands and restore margin. These collapses will be interpreted by surface-level analysis as proof that the thesis is wrong. In reality, they are proof that control is weakening. A market that is truly controlled does not need violence. It needs monotony. Violence appears when control is contested. The silver market is now contested terrain. At the same time, industrial behavior is quietly locking in the outcome. Industrial consumers do not trade charts. They secure supply. When uncertainty rises, procurement shifts from just-in-time to just-in-case. That shift multiplies demand without increasing consumption. It is inventory demand, not usage demand, and it is extremely price-insensitive. A factory would rather overpay for silver than shut down production lines worth orders of magnitude more. This is why substitution narratives fail. Silver is not being consumed because it is cheap. It is being consumed because it is necessary. Until price reaches a level that forces true substitution or recycling at scale, industrial demand will remain sticky. This creates a structural floor that rises over time. Meanwhile, the paper market continues to generate signals that encourage selling. This divergence creates confusion for participants who rely on technical frameworks. Technical analysis assumes liquidity. It assumes that supply responds to price. When supply is inelastic due to policy and depletion, technical signals lose predictive power. They become traps. This is why price can look weak while fundamentals tighten. The weakness is synthetic. It is produced by financial positioning, not by surplus. Over time, synthetic weakness invites physical extraction. That extraction reduces the system's ability to produce further weakness. Eventually, the lever breaks. When that happens, the adjustment is abrupt because there is no inventory left to absorb it. This is the phase the market is moving toward, but it has not reached it yet. There is still enough metal in the system to create illusions of control. That illusion will persist until it cannot. The final phase is not marked by a price spike alone. It is marked by a change in contract behavior. Delivery terms become stricter. Cash settlement becomes normalized. Force majeure clauses are invoked. At that point, the paper price ceases to be a price at all. It becomes a reference number used to close obligations, not to source metal. Physical price discovery moves entirely off exchange into bilateral contracts, long-term supply agreements, and regional premiums. This is how commodity benchmarks die. Not with an announcement, but with irrelevance. Participants who understand this are not trying to time the top or bottom. They are positioning for access. Access is the scarce variable now. Capital is abundant, dollars are abundant, silver is not. This inversion is the defining macroeconomic feature of the next phase. It extends beyond silver. It applies to energy metals, rare earths, and strategic inputs across the industrial stack. Silver is simply one of the first to expose it because it sits at the intersection of monetary history and modern technology. The system built on financial abstraction struggles when confronted with physical limits. It always has. The difference now is scale. Global supply chains, financial leverage, and policy coordination have amplified both efficiency and fragility. When a constraint appears, it propagates faster and wider than in previous cycles. This is why the current situation does not resemble a typical commodity bull market. It resembles a regime shift. In regime shifts, old signals fail and new ones emerge. Inventory replaces price, policy replaces sentiment, flow replaces narrative. Participants who continue to operate as if the old regime still applies will be repeatedly surprised. Those who adapt will appear early, then obvious, then inevitable. The silver market is no longer asking whether price should rise. It is asking who will be allowed to buy before it does. That question cannot be answered by charts or commentary. It is answered by contracts, vaults, and borders. The borders have tightened. The vaults are thinning. The contracts are being rewritten in practice, if not yet in language. This is the end stage of financialized commodities. Not collapse, but decoupling. The paper layer will continue to exist because it serves administrative and hedging functions. But it will no longer govern the real market. The real market will govern it. That inversion is already underway. When history looks back on this period, it will not focus on a single headline or price print. It will focus on the moment when physical constraints overwhelm financial design. That moment is not coming. It is here.